What we've got is a lineup that is headed by Lucrezia Reichlin, who is, as you know, former Director General of Research at the ECB and now Professor of Economics at the London Business School. Lucrezia was a founder of Nowcasting Economics, and Nowcasting is an integral part of the new fund that we are launching, the new equity fund. We will talk about the equity fund a little bit later, but what I'd like to do now is to hand over to Lucrezia to give an overview of the economic outlook for Europe, the economic and policy outlook for Europe in 2021. So over to you, Lucrezia.
Thank you, Michael, and good afternoon, everybody. So where are we now? This is a big question. So we are perhaps coming out of the pandemic, but perhaps we are not. As you know, there are lots of uncertainties about the vaccine, and you know, for sure, there was maybe excessive optimism after the numbers of Q3, but Q4 is you know, bound to be a big disappointment. So it is very likely that 2021 will remain fragile for what concerned economic outlook. And, you know, and maybe, you know, this will scar the economy even beyond, you know, short-term consideration. Now, the good news is that the policy response so far has been much more decisive than what we have seen in 2008 and 2009. And this is, I think, is true both for the US and the Euro area. But the question for the next year and further is whether the policy response will continue to be as supportive as it has been up to now. Now, for the US, the question is about, you know, uncertainties around the fiscal package. For the Euro area, as usual, things are very complex and complicated and full of political risk. So, and I will focus my remarks now on the Euro area as a consequence. So let me just first comment on what has happened so far. So both on the ECB side and on the fiscal side. I think it should not be under-evaluated what has been the kind of joint coherence of the response from, you know, facing the first wave of the pandemic. I think that this has been a first informal attempt of coordination between monetary and fiscal policy. The ECB has supported the financial conditions broadly, while national governments had the flexibility to implement very ambitious fiscal packages, you know, benefiting both from the ECB support, but also from the dismantling, at least temporarily, of the fiscal rules that, as you know, constrains very much what governments can do at the national level. On top of that, the EU designed this recovery plan, Next Generation EU plan, which was meant to intervene in a second phase, what they anticipated to be a recovery after the shock of the COVID, to do something more than stabilization, something extremely ambitious, which is more like to be understood more of kind of a sort of Marshall Plan for the new era rather than a stabilization tool. This new tool had very innovative elements. First of all, it's the first time that there will be common debt issuance in a large scale. So it's perhaps the beginning of what it's supposed to become a safe asset in Euro. I mean, it's just the beginning, of course. We are still talking about a very, very limited first step, but you know, an important first step anyway. And the second important element has been a very strong distributional characteristics in the redistribution characteristic in the way the funds will be allocated. on the basis of countries' needs rather than countries' GDP weight. So, and this via grants and via loans. So this is all good. So, and you know, if we had a kind of linear type of situation in which first a shock, a COVID, and then a recovery, the linearity of this policy response would have been unchallenged. So first, the first line of defense is government plus ECB. The second line of defense is the recovery fund. Unfortunately, things turn out to be not as simple because, you know, we are not out of the woods yet. And we don't know for how long we'll be, you know, in the woods. So the risk in 2021 for the euro area are very much related to the ability of this ambitious new response to adapt to the new situation. So a situation in which uncertainty would remain large because of also of the uncertainty on how the pandemic will evolve, and you know, although there are good news about the vaccine, then we don't know exactly when you know the change will be you know be material. So the key on this, I think the risk on 2021, I mean, in 2021, what can we expect? I mean, with the protracting fragility from the economic side, is that the financial sector will probably be hit. We know that the numbers on non-performing loans are going north. We know that bankruptcies and insolvency problems are very severe in countries, also in countries like France. So there will be most likely solvency problems and not just the temporary liquidity problems for which the response were well designed. And also there will be limit to what nationals, and what can be done at the national level for fiscal support, since you know the line of defense will remain national, and it is increasingly likely that the money of the recovery fund will come at a later stage, but also remember that they will, that tool was designed for quite different purposes, not for stabilization, but for, you know, long-term growth and transformation. So it was easier to find a kind of consensus between the different parties involved to respond to the first wave of the crisis. That was the emergency. Everybody's in the same boat. The shock is the same. So we need to show solidarity. So that was, you know, challenging, but at the end, you know, they came together. Is going to be more difficult and more divisive, you know, the discussion on how to deal with what is likely to be a very heterogeneous situation among member countries, and with problems that, you know, will not just involve liquidity, but also solvencies. So, what are the fiscal risks? I will talk about first about what, in my view, are the risks coming from the fiscal side and what are the risks coming from the monetary policy side. From the fiscal side, I think that one risk is reintroduction of the fiscal rules too early. Okay, so that we know that there is a discussion right now at the Commission. There is also a review of the fiscal framework, but you know, we don't know exactly where this is going to go. The second risk is early consolidation, fiscal consolidation in Germany. Germany had so far a quite impressive fiscal stimulus, but remember that they have a balanced budget rule, and you know, the discussion now in Germany is, you know, when are we going to start thinking about consolidation? So if this happens too soon, there will be the usual problem of the macro adjustment in the euro area. So, you know, that the support on aggregate demand for the area as a whole will be weak because Germany is the big engine. And of course, the ECB will remain, as usual, overburdened and, you know, probably the only game in town. So the other risk is that there will possibly be, you know, some kind of moral suasion to high debt countries to consolidate too fast. And again, here, the profession and also the policymakers are quite divided on how fast you should start worrying about government debt. On one hand, everybody says, you know, this is not the moment to worry about government debt. On the other hand, the countries which are over indebted, like for example, Italy, are worried themselves. And they're in fact discussing about how to use the resources, the future resources of the recovery fund, not so much for new projects, transformative projects, but actually to finance projects which are already been in the line. And that, of course, that would be a self-defeating purposes of the new tool, of the new recovery fund. So, in other words, there will be pressures. I mean, from the fiscal side, it's not at all obvious that things will continue to be supportive as they have been in the first phase of the crisis. Now, there are signals, for example, that the EU, in the context of the discussion on the budget for 2021, have been already made some noise with respect to high debt countries like France, Greece, Italy, Portugal, and Spain, you know, to be careful and to start thinking about, you know, the issues of on the fiscal burden. The fiscal deficit, you know, for in the next year will be quite substantial. So, you know, the aggregate deficit will be something, you know, in the area of 9% this year and maybe 6% next year. And, you know, and this is this will increase, this expected increase in the Eurozone government borrowing will be around 1.5 trillion, something in that area. And remember also that Italy, which is, you know, the second largest in that countries by debt, you know, will touch a debt to GDP ratio of around 160%. And this is very likely to be the number. So remember to assess the kind of risk of this discussion of going too fast or going too slowly in that consolidation. You have to appreciate that in the euro area, this discussion, which is taking place everywhere in all jurisdictions, in the euro area, this discussion is quite different because do not hear that. So this is very different from a unitary system like the UK and the US. So you know, then we will have to be aware that you know, different countries in the EU face different risk profiles and therefore potentially different financial conditions. So the ECB will have to be able to, you know, to stay in and to compress spread, you know, maybe for the next few years. But this is really quite controversial because this is not exactly what monetary policy is supposed to do. According to textbook, it has more the flavor of quasi-fiscal policy. So the question, however, if the fiscal policy is not going to be supportive, so can monetary policy do it alone? What is the chance that the ECB will have the carte blanche to act decisively in the government debt market? Now, in principle, it could, okay, and we have seen that the ECB has surprised, you know, over time in being more ambitious than people thought it could have been. But and in principle, the ECB could transform its holdings of public debt in perpetual loans. Okay, this is a discussion that seems to be unconceivable just a year ago, but this is a very active discussion today, not only in Italy, which would not be surprising, but also in France. Okay, so in France, there is a kind of a committee that is now looking at this problem. And, you know, but this obviously will be extremely divisive unless the ECB will be able to link, you know, the new kind of package of different forms of QE, you know, the APS and the PPP into some kind of target of price stability or nominal GDP targeting or inflation, you know, some kind of nominal target for the euro area as a whole. So this is something that is being discussed in the strategy review at the ECB. And maybe something new will come there, but you know, I'm not 100% sure that actually they will be able to be, you know, so clear about the linking future actions to something like nominal GDP. It's more likely that they will just clarify something about their inflation target. But actually, the difficulty is going to be, beside the political difficulty, for the ECB is going to be communication, because if they cannot link this quasi-fiscal intervention through various forms of QE to a clear nominal target, price stability of inflation, and this is increasingly difficult to do it since inflation, you know, has not moved that much, and notwithstanding, you know, the various packages, it's not clear how they can justify it. And we know that communication is extremely important. And if you want to understand why it's important, just look at what happened on Thursday with Lagarde's communication to markets. So they actually announced some increase in support, but the market was quite disappointed. And, you know, if you look at how the ECB talks these days, I mean, they say we want to support financial conditions. They define these financial conditions in quite a general, holistic way in which they have everything in there: corporate yields, sovereign yields, exchange rate. They put everything in a package. But this doesn't make the framework very clear. And I think that there is a confusion in the market about what exactly are they doing? Are they doing yield curve control? Are they trying? So what is the macro framework that justifies further actions? And this will be important down the road if there will be a need for them to step up action. So communication is important. We know that, you know, from Thursday, where the market was not impressed, and in fact, the euro, you know, strengthened, and there was a sell-off of bonds and so on. But, you know, down the road, this risk could be amplified. Remember that we have been there before, from 2012 and 2015, when the framework, monetary policy framework, was not very well designed from the ECB. There was a lot of hesitation of implementing QE in those years. So, and then QE was now, with the benefit of you know, having seen history, you know, was possibly was implemented too late. Then, you know, the market was very confused. And as the ECB was actually announcing new policies like negative interest rates or new special loans to banks, instead of cheering, the market actually was confused because it was expecting something more. It was expecting QE. And so by the lack of QE was actually a negative, notwithstanding these other measures that were being implemented. So conceivably today, we are facing a similar situation in which the ECB is doing stuff, but is not really explaining it well, because exactly there is no consensus within the governing councils of why they are doing what they are doing and what is the justification. And, you know, we have to wait, you know, for an interesting discussion in the context of the strategy review of where this will go. Now, so challenges going ahead, as I said, possible fiscal monetary crosswinds. I talked about Germany going against, you know, a possibly expansionary monetary policy, you know, facing this protracted fragility. Discussion, possibly divisive discussion, so within the Eurosystem and the ECB, to redefinition of the objective, a clarification of communications. And you know, possibly also the lack of a fiscal tools is, you know, it's also a problem in itself, because as we know, with this kind of crisis, COVID related, which implies a lot of heterogeneity across sectors and countries, the monetary policy tools is not terribly effective. So we need more targeted tools like the fiscal tools, but this remains fundamentally national for what stabilization concerns in the area. So to make this story short, the question is, are we going to face in 2022, okay, I don't expect 2021 to be the relevant horizon, a kind of revisiting, a kind of revisit crisis, a kind of type of crisis like the debt crisis that we had in 2011 and 2012, but just 10 years later. I mean, what are the risks? Of course, the biggest risk is that some countries, like, for example, Italy, which had a very long, beside the fiscal and monetary risk that I described from the real side of the economy, that growth will disappoint, and that the recovery plan will have millions of implementation problems, which not to be, which are obvious risk, because the governance of these grants and loans is going to be quite challenging. And so as a consequence, the fiscal burden will be higher than expected in some countries, but not all countries. So the ECB will be limited on how, skewed their interventions can be in relation with some jurisdictions. And so the combination of these things could actually possibly, bring us back where we were 10 years ago. So is this my central scenario? I think this is a very significant risk. But actually, I think that maybe this time this is not going to happen. We should not underevaluate the political will of, keeping together this time. And, I think we had, the first response was quite, impressive in that sense. But, the risk will move the frontier further. And this, it will be a very significant challenge. So the euro area remains, a quite risky, part of the world. Thank you very much.
Good. Lucrezia, thank you. Can I just quickly ask you a couple of questions before we hand to Jasper? There will be an opportunity at the end to ask Lucrezia more detailed questions. But let me just pose a couple now, if I may. One of those would be, is it possible for European interest rates to go more negative? That's question number one. Question number two, which may be linked, is if the euro surged towards 140, which some people, maybe including ourselves, have suggested, what would the ECB do? And the last one, to sneak in a point about this agreement or consensus, is if you had to put a scale of 1 to 10 on the degree of consensus or agreement among policymakers in Europe, with 10 being the highest, where would you say we sit?
Okay, so negative interest rate, I think it is possible, but in my view, this is it is unlikely because there is a very, very strong opposition on going further negative from, especially in Germany, especially from the banking sectors. And if the ECB analysis itself, although there have been a first studies showing that actually the negative interest rate has not hurt the profitability of the strongest bank because they were able to, to pass on the cost to corporate clients, to the negative interest rate to the big corporate clients. I think increasingly the ECB is more concerned about the risk of going further negative. So I wouldn't be surprised if they would be much more likely to explore, further form of QE, and especially, different creative form of TLTRO or the like, which is their specialty, before going to negative interest rate. On the other hand, the big exchange rate, and we know that negative interest rate, if it has an effect, it is on exchange rate. So we will have to see what is the tolerance. And I agree that this is a big risk, especially because the US seems to be, much more proactive as usual. So what they will, I think that, as you know, the rhetoric of central bank is that they don't target exchange rate, but there is a difference between the rhetoric and the reality. So I think if this, if there is a persistent, pressure of exchange rate, then it is possible that then a negative interest rate will go back to the package. But I think as it is, I think it's, as you see, I mean, this is not where they went, and I expected that to be the case. Now, from 1 to 10, I think that the consensus has shifted. That I think that one of the problem of the euro area crisis of 10 years ago was that actually not only the interests between countries were different, but also the philosophy, also the way in which they understood the best practice in monetary policy and fiscal policy. I think that now there is a little bit more convergence. If you see this administration in Germany, has been very much fiscally active. Okay, for example, the decrease in VAT, was a big, big shock. They're being very proactive. However, it remains a fundamental, belief in Germany that, that there has to be balanced budget. I mean, this is actually a law for Germany, so that, and this is the current discussion now. But I think the country is more divided than it used to be. Okay, so that, there is more. And on the need for having common tool on stabilization, I think also the consensus is moving. On the need of having a safe asset, the consensus is moving. And after all, von der Leyen is German, and under von der Leyen, we have achieved quite a bit through the recovery fund. Nobody could have anticipated it, a few months ago.
Good, thank you. Thank you.
You're welcome.
Should we turn to Jasper to give an outline of the nowcasting framework?
Just shifting seats. Hello, everybody. Good afternoon. Let me give a very brief overview of nowcasting, what it is and how it's relevant. So nowcasting as a business was founded by Lucrezia and myself and 2 others just over 9 years ago in 2011. And our intention was to commercialize the academic work that Lucrezia and her colleagues had done in pioneering the development of this class of statistical models known as nowcasting models. And as many of you may know, these models in their early years were developed very much by and for central banks. That's where Lucrezia's early work was. She subsequently became Director General of Research at the ECB, as Michael said, and the model evolved not only under her leadership, but others as well. So the original rationale for developing these models was to answer a very obvious need among central bankers, which is to get an up-to-the-minute gauge of the state of the business cycle. Because if you're setting policy rates, they're effective in real time, but all of the information you have about the state of the real economy, the state of the business cycle, is out of date because all of the key measures on which you rely, most obviously GDP, are subject to long and variable publication lags. So the rationale for devising these models was to take advantage of the multiplicity of different data series that there are out there, and to find a way of doing as sophisticated, if you like, an interpolation exercise as possible. So what the model does is to take as inputs a large number of different real economic series. They're mostly monthly series and they're all publicly available, widely followed series like industrial production, retail sales, imports, exports, as well as all of the key surveys, in particular the PMIs. And exploiting the fact that as far as real economic variables is concerned, there is a high degree of co-movement. What the model does then is to extract from a history of these variables one or more common factors, which are vectors of monthly values, which can then be used as the basis for a projection. As they synthesize, if you like, the co-movement amongst these real economic variables. That's the basic idea. So you can think of it, if you like, in economic terms, it's quite a simple concept, but in engineering terms, it's a highly sophisticated tool because it has to cope with a great deal of heterogeneity amongst these different series in their degree of volatility, their publication lags, they're all asynchronous and so forth. So it uses some sophisticated techniques to get over those problems in order to gauge the significance of every new piece of information that arrives as every one of those series is published. So what we did as a business was to build an automated platform and to take the latest generation of these nowcasting models and apply them to each of a number of countries so that we could and then set up these models, the automated platform, so that they would run continuously, being updated with new information as soon as it arrives. And we get our input data from a company in New York called Haver Analytics, who are specialists in this field, and we get updates of data releases literally within seconds of their publication. Whenever they arrive, they trigger the model to run and to recalculate all of its outputs, and we deliver those recalculated predictions to our clients. So what is this worth and how is it used? I actually had a question the other day from someone who may even be on this call in the wealth management industry, saying, surely it's well established, and I apologize if I paraphrase this question wrongly, but surely it's well established that GDP and other variables do a bad job of predicting financial variables, stock market movements and the rest. And it is certainly true that a lot of the historic literature in economics and finance supports that view. However, when you actually look at real economic variables through the lens of a model like the nowcasting model, what you're able to do is to, if you like, anticipate the market's reaction to economic surprises. So what the model is good at doing is to say, if you to identify the signal and filter out the noise in each successive economic data release. So whenever we get a new data release, and by the way, you can see this on our website if you subscribe to our service, you see as each new data release is published, we show what the impact that each successive release has on the model's prediction of GDP, and we show how that has been calculated, how it breaks down between the weight that the model has dynamically ascribed to that particular release and the value of the release itself, and the difference between the value of the release and what the model predicted, because the model has a prediction for every release. So when a release is published, the difference between the release's actual value and the model's prediction of that value is what we call the news. And if you multiply the news by the model's weight, then you get the impact, the amount by which the model adjusts its prediction for GDP, or for that matter, any other variable in relation to that specific series. So what is effectively going on there, as I say, is that the model is, you can think of it as a signal extraction machine. And if you then think of it in terms of financial markets, and you look at, as various people have done, the stock market's response function in relation to economic surprises, you'll see that the market does react, but it doesn't react instantaneously. Some of the reaction is instantaneous, but it doesn't settle on, if you like, a full evaluation of each economic surprise instantaneously, whereas right or wrong, the model does. So in that vein, one of the things that we do is to derive from the model an economic surprise index, which is comparable to other surprise indexes in the market, like the City Surprise Index, except that ours is based entirely on the model. It's the model-based surprise and the model-based and the model's own weights, whereas the Citi and other surprise indexes are based on market consensus and some extraneous form of weighting. And I won't go into this in any great detail now, though I'm happy to take questions, but suffice to say that on some fairly high-level analysis of this, it looks very much as a model-based surprise analysis, a surprise index, does at least as well as a consensus-based surprise index in predicting asset price moves. So let me wrap up. In relation to the fund that Michael and his colleagues are talking about today, and you'll hear more from in a moment from Hayden, the real significance of the nowcasting input, and we've been working closely in collaboration with Michael and his colleagues for some time on this, is that the output from the nowcasting model can be used as an input to the algorithm that drives the fund in the form of, if you like, a very up-to-the-minute gauge of economic momentum, of real of momentum in the real economy. So we're looking for inflection points in the business cycle, moments of acceleration or deceleration. I'll hand it over to Hayden there.
Good, thank you.
Thank you very much, Jasper. It's very kind. I'm just going to share my screen, and then we can see the presentation. If we can all see that, that'd be great. So the fund itself is a way to efficiently invest in equities, of which these are the most liquid index futures in the world. What this does is covers around about 95% of the MSCI world. The fund aims to outperform the MSCI World Index over long periods. It does this by systematically exploiting inefficiencies in macro data. It does this by synthesizing the nowcasting data that you've just heard from Jasper and liquidity.com's risk appetite data. The simple rule that we find is if we see that markets are overbought, so are skewed towards risk on assets, and the economic outlook for that country is poor in comparison, we see that as a buy signal. And vice versa, if we find that a market is underbought or heavily skewed towards risk off assets, and the underlying economic data is upbeat, we see that as a buy signal. The fund itself has consistently lower volatility. This can be attributed to the fact that we are, unlike some quant-based funds, we look at a risk management system that incorporates a reduction in gross book if a relative 6 months VIX value is exceeded. We also find that drawdowns are far fewer and further between than the MSCI World Index. We find that because, as Jasper said, the fund targets inflection points. So we find that as markets rebound, we tend to pivot and be in place to see the rebound, and vice versa. When markets collapse or correct, we are usually in place to pivot and position ourselves to see that. The fund is entirely systematic. So what that means is that it's the data handling, it's the retrieval of data, it's the straight through processing platform, which we invest with, is entirely systematic. So that takes out the painstaking human element to it. As I've also said, that the MSEF is highly liquid and only invest in the highly liquid index futures. Bear with me. So this is what we do, or the data team at liquidity.com does. So this is a slide on risk appetite or the risk sentiment in a market. So instead of looking at a qualitative mix or surveying portfolio managers on what they currently believe to be the case in markets, we actually look at holdings data. So what we do is we find a quantitative mix of risk on assets and risk off assets. So we find that risk on assets are typically equities, emerging markets, or corporate bonds. And we find that government bond holdings, liquid assets, etc., can be defined as risk off assets. And what you can see on the right-hand side is how in step this risk appetite value is with the business cycle. So what we do is we find a normalized series and we index that. So what you find typically is it's between 50 and minus 50. It's this red line here, and standard deviation bands of 20. So what we find is the best times to invest are when these values are inflection points. So this is, as I said, when you typically find corrections or rebounds. It's in these middle parts, however, where you can still find investment opportunities. And that's when you find discrepancies between the risk sentiment and the business cycle. So what we do is we incorporate, this is on a global scale, but what we do for 20 markets, or can do for 20 markets, and we typically invest to 12, is we find how the discrepancy between the risk sentiment and the business cycle for each of these 12 markets, for example. When we find these differences, we invest where appropriate. As you can see in the bottom right, this is 2020. Our systems were telling us, as you can see at the bottom, markets shift towards a very risk-off sentiment. What this meant was that our model repositioned itself for the inevitable rebound, which came in the form of US markets in April, which filtered through to Asian and European markets. We still find that there's plenty of opportunity in some markets, which I'll go on to explain in a minute. So this is how it's constructed, the strategy. So what it takes is a equal weighting of nowcasting and risk and the risk appetite. The idea behind this was we wanted a robust signal that wasn't optimized or backfitted in any way. So what we do is to take a 50-50, we find the difference between the two, and then we can find a portfolio, we can find a trading signal from there. We apply trading bands and the risk loss management system, which, as I said, incorporates both a drawdown value, so drawdown on each market, and the level of the VIX. From here, we can then apply country weights, which are based on risk parity. So the more or the less risk a market is, the more we tend to invest. With that, we restrict our dealings in or exposure to emerging markets to 20% of the portfolio. This just goes to show maybe why we've done so well this year. It comes to the fact that these are direct comparisons of 2008, 2009, and this current financial crisis, if we can call it that. We found that the rebound in GDP momentum far exceeded, or was much faster than that in 2008, 2009, which helped us reposition for this rebound. And as I mentioned before, on the right-hand side, the depressed value of the risk sentiment value was at the lowest it's ever been, far exceeding that of 2008, 2009. When you put these two together, you get ultimately a very much a buy signal, and hence we've produced fairly well this year. So this just gives a little color into where we're currently positioned. The main takeaway from this is we find that US economic momentum data is flatlining, with risk appetites becoming above par. What we find what we calculate that to be is a sell signal. That is the same with the majority of European nations. When previously, a month or two ago, we had these as screaming buys. These have now pivoted, and as you can see for the Eurozone, Germany, France, these are now typically sell signals. We find with the UK and Canada and Italy, these are still very much buy signals. That being that risk appetite is not reflected in the economic data that is apparent. So we still find that markets in the UK, Canada, and Italy can improve. Yeah. So this just gives a little bit more color into performance. So what you find here is that we have a live track record. What this includes is time spent with Marshall Wave's TOPS program and the current managed account that we're running. So this is live money. As you can see, this year has been particularly good with returns of 24%. This tells of the fund's characteristics in good and bad times for equities. So on the left-hand side, this highlights the defensive capabilities of the fund. As you can see, the average value far exceeds that of the MSCI world. This is, as I've mentioned, when markets typically get greedy, we position ourselves for the correction in markets. And as you can see, that's why we exhibit positive returns there. At the same time, in the best months, we have exhibited positive beta with the market. Hence, we've got this to be expected. It's not as good, but it's still positive returns. This just goes to show the beta and the alpha that the strategy generates compared to many of the world-leading benchmarks. Finally, I'll touch on our risk management system. What we do here is we take into account, as I've said, relative VIX index values. When this relative VIX index value exceeds a certain threshold, be it 2 or 3 standard deviations from its norm, we see that as a reason to reduce our gross book. And as you can see on the bottom right, in February and March, our gross book was reduced to 0 until our system thought it correct to reintroduce risk, which it steadily has done from April through to the current day. Okay, I think that's about it for me. But any questions? Yeah, please shoot.
Good. Okay. Should I just thank you, Hayden, for that? What I would say is just a little bit earlier in the presentation, it's well worth highlighting a slide. I think it's your previous slide, or sorry, 2 or 3 back with the nowcasting report. One before, I think. Sorry, 2.
This one here?
No, before. This one. I think it's worth pointing out to everybody the GDP Momentum Indicator that we're looking at for 2020, the one in the lower left, because I think the most significant element of that is the very fact that even in these latest lockdowns, it hasn't dived again. It's remained high at an elevated level. And I think that's a very significant pointer for what happens in 2021. So in other words, the world has sort of learned to live with the COVID crisis in a way that it clearly didn't in March and April of this year. Now, we're going to take some questions. What I would like to do is to maybe have questions for Lucrezia first, for the simple reason I know she's got to leave by 5 o'clock. So if anyone likes to, would like to put a question, I know there are some coming in on the chat. They're basically fund specific. So let's see if anyone would like to ask questions of Lucrezia before she leaves. Please do that, unmic or just write a message in the chat.
It's James Knowles. Thank you very much for the presentation. Fascinating. What sort of levels of nominal growth do you think we need to achieve to effectively deal with the levels of debt we are currently now carrying?
It all depends, of course, on the interest rate, right? So, I mean, as long, if you can do it this real or nominal, I mean, the important difference is the difference between real interest rate and the real growth rate, or if you want to do it nominal, you can do it nominal. But so far, if you look at the past few years, things have been quite supportive, right? Because the real interest rate has been smaller than output growth. But this is what has happened on average. On the what matters for sustainability is also the marginal rate. And so if at some point the market is spooked because the ECB is unable to deal with the specific financial conditions of countries like Italy, for example, then we can think that those two variables, which are important for sustainability, will shift sign, because the cost of raising new debt will increase. So, of course, this is a risk that is decreasing insofar as government is getting into longer and longer maturity. And in a way, this is actually what's happening. So, the thing is a little bit more complicated than just looking at nominal growth rate, because we have to look at the maturity of the outstanding debt, and then the marginal rate, so at the interest rate for the new debt. So I think that so far I'm not worried too much, but I think it's really important to understand where the ECB can be in case the nominal growth will not be supportive. Now, consider that inflation is now negative. Inflation expectations are rising a little bit, but I don't expect, of course, I may be wrong, that inflation by 2022 will be, anyway close to 2%. So, I think it will be more on the area of 1%. Now, the Italian growth rate kind of, on average has been below 1% in the last 10 years. So, things could go wrong in certain countries, okay? So that's the problem with the euro area. That is not one country, it's several countries, and the marginal interest rates could be different depending on the specific risk, which are country specific.
Good, does that answer your question?
Mostly, yes, thank you.
Good. There's another one, Lucrezia, on inflation. I know you've touched on that already, but I don't know if you want to say a few more words, or David, who asked the question, wants more granularity, but over to you.
Well, inflation, it's the big question for everybody, right? Is inflation going to increase or decrease? There is reason to think that this time risks are more material than in the last crisis. And if you think, for example, of what's happening to loans, loans have been going up, not down, so that if broad money has not been collapsing like in 2008 crisis. So it is possible, and this is especially, I think, true for the US, that the inflation pressures will at some point come to the fore. Now, for the euro area, I think this is less likely because of the uncertainty I've tried to describe. I think there is still a lot of risk aversion around, and the combination of monetary and fiscal policy is going to be less supportive of inflation than in the US. So the question, I think, an interesting question to which I don't have an answer, but I think it would be an interesting question to answer, is what's going to happen if you see inflationary pressure in the US, but less so in the euro area? Can we think of a decoupling? What would that imply for financial markets and so on?
Good, thank you. Does anyone have any further questions for Lucrezia? Otherwise, we'll turn to some of these other ones on the fund. So I'll give anybody an opportunity to come with another one. Otherwise, there's questions, I think, for Hayden from Francois Bertrand about the drawdown questions.
I say goodbye to everybody. Thank you then.
Thank you, Lucrezia.
Bye.
Thanks, Lucrezia. Hi, Francois. Yes, mention the value of each max drawdown. So, as I said, the drawdown is it's part of the risk management system. What that means is we take into account a 2% drawdown. When that comes into place, it reduces our gross book once again by 20%. The idea behind the fund is very much mean reversing, absolutely, because we feel that holdings between risk on and risk off assets is very much mean reverting. The signal that we produce is contrarian, so at times of inflection, we position ourselves for these points to come into place. Hence, we do invest accordingly.
It may be worth adding, Hayden, that we've done quite a lot of work using AI systems to explore different risk regimes. We haven't yet incorporated in the model, but they do have actually quite good explanatory powers. So Francois' second question, which is, do we actually model different mean reversion regimes? The answer is they're not incorporated in the model as such yet. We have done that, and they actually come out with pretty interesting results.
Yeah, absolutely. Absolutely.
Good.
Okay.
Do we have any further questions from anybody? I can't see anything on the chat, but if anyone wants to unmic, we're more than happy to take questions. For myself, for Hayden, for Jasper, whoever. But if there are not, we thank everybody. The fund will be launching in January in UCITS form. If anyone's interested, we'd be delighted that you come and join the club. We think there's some great opportunities in markets looking forward. And if this is going to be a more challenging year for equities in 2021, which in all likelihood it will be, I think this sort of fund will be actually a pretty good way to steer through some probably likely many hazards. So thank you all for your time. And oh, sorry, there's a question. One's just come in. One for you, Hayden. What is the frequency of rebalancing?
So the signals that we produce are daily signals. That doesn't mean that we trade every day. In fact, that a typical holding period of our signals is around about 6 weeks. So rebalancing is few and far between.
In terms of the number of turns, do you have that information if it was a sort of CTA?
Absolutely. So it's 500 round turns per million, Francois.
Good. Okay. Well, assuming that we've answered all questions, I thank everybody once again, and have a very good holiday period. And we look forward to catching them again in January. And please express any interest to us if the fund is what you are looking for. Thanks so much again. Goodbye.
Thanks, everyone.
Cheers. Bye.